Hey guys, how are you? This is Eric Bramlett with Bramlett Partners, and today we're here to talk about the July 2025 Austin Metro real estate market statistics. Before we dive right in, I want to remind everyone that real estate is hyper-local and hyper-situational. So if you'd like to discuss your specific situation, please reach out to us and we'd love to strategize with you. If you're a homeowner who's considering selling, if you're a buyer who's interested in potentially dipping your toes into the market, or if you're a real estate professional, we'd love to chat with you. So reach out and let's talk about your specific situation and your specific submarket. That said, let's jump right into the statistics. July numbers were relatively similar to what we've seen in the past. We have a bit of up, a bit of down, and a lot of sideways. First things first, total sales did dip by -4%. But under contract and pending units increased by 9%, which is a leading indicator, and that does lead us to expect we'll see total sales increase in the next month or two. New listings increased at a faster rate, 13%. So while there is a bit more demand in the market in July, there was also more supply that hit the market. That did cause months of inventory to increase by 19%, which sounds dramatic, but another way to say it is that MOI went to 5.3 months versus 4.5 months of inventory in 2024. That puts us on the high side of a balanced market, but it certainly feels like a buyer's market out there. Average days on market to sell is 72.5 versus 64.7 in 2024. Whenever a seller needs to sell, we're looking at this as a 2 to 3 month journey, and pricing is very, very critical. Pricing itself, very small uptick on average, 2.5% decline on median sold price, and then average sold price per square foot dipped by 3%, and median sold price per square foot dipped by 4.4%. Buyers and sellers always want to know, is it a good time to buy? Is it a good time to sell? It can never be both a good time to buy and a good time to sell. So the question we like to ask and answer is it a safe time to buy and is it a safe time to sell? And pricing is very stable. If you look at 12 months of pricing history on average and median, it really can't get much flatter than that. And what we tell everyone is that now pricing has been stable for at least 24 months. So this month, I went ahead and looked at the data for 24 months, and this is what that looks like visualized whenever we look at 24 months of average and median sold price. And I think that we would all agree that this is incredibly flat. Pricing looks kind of like a pancake right here. Just a very, very, very slight increase in average sold price and a very, very slight decrease in median sold price. Another way to look at demand is to investigate the total volume sold. And volume is the dollars traded in a given time. January 2025, we saw a dip of 3.26% versus 2024. And year to date is just under 5%. So that just shows that there's less demand out there in terms of total purchases. This is a good number for buyers and sellers to look at, but it is most impactful whenever real estate professionals look at this because this is the total amount of commission pie that's out there. So if it feels tougher this year, it probably is just a little bit tougher, but there are other dynamics going on, and we know that there are a lot of real estate professionals that are succeeding in this market. Pending units, this is one of the most important metrics that we look at. On a month-over-month basis, you will see pending units decline beginning in April, and it'll be a straight line decline until the market resets in the following spring. That is happening this year. We saw an uptick in July versus 2024, and you can see that visualized here. It is really, really nice to see. We do expect seasonality to remain very consistent. We expect pricing to be incredibly important for sellers that need to sell this year, so watch that seasonality. We look at new listings, and you can see that new listings are up even more than pending units. So even though there is more demand in the market, there's more supply, and that causes the market to soften just a bit. This is a marketing piece that is actually in our listing presentation that we show to every seller, and this shows you that the demand peaks in the spring. It's still great in the early summer months, and then in the mid to late summer months and through the holidays, demand just is a straight line decline. So if you're a seller on the market right now, really important to be mindful of seasonality. Get ahead of the market, don't chase the market down, but also know that seasonal demand will come back next year in the spring months. Moving on to leading indicators, this is consumer sentiment, and we had a low of consumer sentiment in April and May of this year. Whenever the tariffs hit, you can see that the consumer sentiment has stabilized. That increased pretty nicely in June and July. We're still not back to levels that we saw pre-March, but consumer sentiment has rebounded pretty nicely. There was a negative jobs report recently, and so we do expect consumer sentiment to dip just a little bit. You can see that the next report will be on August 15th, and the forecast is that it'll decline just very, very slightly. We look at the fear and greed index quite a bit. This shows you sort of a daily temperature of what the stock market looks like. That moved to neutral right after the jobs report, and it's moved back into the low side of greed. We're at 59 out of 100. That's still good. It means that the stock market is overall bullish. We're not seeing a sell-off or anything like that. It's a great metric to watch. Silver lining from the bad jobs report is bad news is good news for the mortgage markets. And as soon as that jobs report was released, mortgage rates dropped. We're now just over 6.5%, which is great to see. The reason this happens is that unemployment is deflationary. So this causes markets to expect the Fed to drop rates. And so it's about the anticipatory rate more than anything. And this is an illustration of that. So the latest jobs data sits in support for 3 rate cuts in 2025, whenever the market has expected 2 rate cuts in 2025 up to this point. Looking at the CME Fed Watch tool, you can see these are the September expectations. So we do expect to see the Fed make a 25 basis point rate cut in September. There's an almost 90% probability of that according to the market. And then the new expectations after the jobs report are the market currently expects 45% likelihood of 3 rate cuts and a 43% expectation of 2 rate cuts for the market. This is a friend of mine, and I like to show this to our agents quite a bit. And what Mike says here is that the question to ask is, no matter what the market conditions are, what can I do to be successful? And that brings us to the strategy, right? So yeah, we can't affect what's going on in the market. We can't affect mortgage rates. We can't affect consumer sentiment. We can only monitor these things. And then as professionals, as consumers, we have to look at this and say, okay, great. Given the current market conditions, what can we do to be as successful as we possibly can in this market? And hey, that's where we come in. So if you'd like to discuss your specific situation, please reach out to me or reach out to the company, and we'd love to chat with you about that. Again, I'm Eric Bramlett. I hope that you have enjoyed this. Thank you for watching this for this long, and I hope you have an amazing week. Thank you so much.